Hey there, listeners, and welcome to the National Land Realty Podcast. Once again, my name is Mac Christian. I'm the Chief Marketing Officer with National Land Realty and the host for this podcast. Now, today is our super special quarterly treat where we sit down with Jackson Takach. Jackson Takach is the Chief Economist and the Head of Strategy Research and Analytics for Farmer Mac. Now, today in this episode, we will discuss a change in that title. I don't want to give it away just yet. If I give it away just yet, it takes away the whole point of listening to the podcast. So he has a new title. We talk about that a little bit. But here's the really important stuff that we talk about today. Today, we're talking about what happened in 2025 to farmland values, to land values in general, and what we anticipate happening in 2026. We're covering everything from tariffs to input values to water rights. And a really cool topic that we got to discuss. We actually delayed this podcast so that we could cover this topic. The USDA report just came out and we dive into what it tells us. Now I'm sitting here tonight. I take off tomorrow for the National Land Realty National Conference. We do this thing once a year. It's a pretty big deal. And I just wanted to make sure to get this out there. So sit back, enjoy. This is a super special episode. And stay tuned. I know there's been a little bit of a delay in our episode launches. We wanted to really organize our content for the year. So we took a couple weeks there to kind of figure things out. We have a lot of cool episodes coming at you here soon. So stay tuned. Subscribe to this podcast so that you don't miss our next episode. And thank you. Okay. And I am sitting here with Jackson Takach. We're going to go into this a little bit, but I'm going to say the Chief Economist and Head of Strategy Research and Analytics at Farmer Mac. And cut to you. It's no longer that.
That's right. I have a long history of just title updates and commas and all sorts of changes to titles over the years. But I'm really proud and excited and honored to take on a little bit of a new role. So to keep the Chief Economist for now, right? So I'll still be your go-to guy for things economic and finance and land and farm related. But I'm taking on a new leadership position at Farmer Mac called the Head of Farm and Ranch. And really what that role does is coordinate all of the business development operations, the underwriting operations, and the analytical functions of our largest business unit called Farm and Ranch. So that's things like mortgage lending for agricultural mortgages. So as a secondary market for ag mortgages, we buy those every day from lenders across the country. It's that program. It's USDA guaranteed lending program where we are a secondary market for USDA guaranteed loans, as well as our long-term standby purchase commitment, which is kind of like a mortgage insurance product that we use to help people support their credit needs in their portfolios. So honored to take on this role. It's a coordinating function. We have never had it before. Again, this is what I do at Farmer Mac. I take on roles that have never existed and try to do my best to really make them hum and make the best for Farmer Mac, for our customers, for our borrowers, and for all constituents that get touched by rural America, which is, it's everybody, right? Between the food system, the energy system, everything that Farmer Mac touches is a shared experience by all of us. So it's a real honor and a pleasure to take the role.
I just love that you're working in our language range now. Like at National Land, you got Farm and Ranch. It's like, okay, yes. Now we're talking.
Strategy, research, analytics. That's a lot of commas. There's a lot in there. So Head of Farm and Ranch, I think it's direct, it's easy, and totally related.
And so is that just because I think that would be awesome? Is it getting tacked on to the end of the previous title, or is this previous title changing?
The previous title changes. So, sadly, Strategy, Research, Analytics still exists as a unit, which reports up through my role. But the title itself is no more. So fewer commas, which I think is okay. If the world lives with fewer commas, I think we'll all sleep fine at night.
So you're saying that your LinkedIn profile is actually going to be on one line?
Yeah, probably, and maybe a business card too. Like it might actually just fit on one line on a business card, which would be a real change for me. Yeah,
that's perfect. Okay, so and then a little bit of background if you want, real quick. Just again, we do this quarterly for anybody that hasn't listened to this, our quarterly updates. A little bit of background on Farmer Mac and sort of how you function. You already touched on it a little bit, talking about secondary marketplace, but just a abbreviated version of sort of what y'all do.
Yeah, I mean, that's it. We provide liquidity. We provide a place for lending institutions to sell assets, including farm and ranch mortgages, USDA guaranteed loans, infrastructure finance loans to cooperatives and project finance. Also for broadband infrastructure, as well as agribusiness loans. So really anything in that spectrum that's touching that rural economic engine of food, fiber, fuel, energy, and connectivity, there is a place for that at Farmer Mac as a secondary market. And we have folks all across the country who work with lending institutions to increase the scale, efficiency, and liquidity of capital. Every single day we live, breathe, eat capital and liquidity. And that's what we were born to do for the last 36, 37 years.
Excellent. Thank you very much for that. And so as we were talking this week, we rescheduled a previous recording that we had because the big thing that came out yesterday was the USDA report. And that obviously is going to carry some impact or show us the measurements of the impact that happens throughout ag industry throughout the United States. Walk me through some of the insights that you found.
Well, it's a big release. Every year, the USDA does 3. Last year, they only did 2 because of some, shutdown activity. But this year, I expect there to be 3 releases where they actually unveil their look at what the farm economy is going to do. They kind of total up all the ones and zeros across all the sectors and say, here's what we think the health of the ag economy looks like in so many different ways. There's balance sheet, there's income statement, there's land values. I mean, everything's kind of rolled up into these 3 releases. And the first one of the year, the February release, is the first time they look at the next year, right? So they'll do 1 in February for 26, and then they'll do 2 more in 26 to kind of update things based off of how commodity prices trended or expenses trended. So they know more later in the year, but the February one is always the most fascinating because it's the first time you get a glimpse into the mind of the hive of economists at the USDA for the coming year. So that was yesterday. They dropped a treasure trove of data. We hadn't seen data from them since September because the government shutdown really interrupted their usual release in December. So we were kind of operating almost blind from USDA ag economists for the last 4 months. So I tell you what, me and the other economists out there in the world, we were licking our chops, hitting refresh, at 10:59 to see exactly what was coming down the pike. Before I clicked refresh and got the numbers, my gut was telling me it was going to be a bit of a drop from their expectations of 25, right? 25 was a tough year for a lot of the grain and oilseed operators out there. So if you're renting ground, your expenses were high. Putting seed and growing stuff was very expensive in 25. And we saw a lot of price fluctuations, market volatility in those prices, particularly in the oilseeds, right? Soybeans was a lot of volatility. It was hard to sell them. Export markets really locked up due to some trade disruptions. Same with rice, same with cotton. So, everything in that Southeast was kind of locked. And so my expectation heading into 26 was, hey, we're going to see a dip. When I clicked refresh and I got the numbers, what I found out was USDA actually increased their expectation for, between 25 and 26. And I kind of scratching my head and wait a minute. They're going to make more money this year in 26 than 25 with all these headwinds that are kind of like percolating right now. And when you dig into it, I was actually right. What they did was they took the 25 numbers and they said, hey, we overestimated what we thought farmers were going to make in 25. 25 was worse than we thought. So we're going to drop the level of expectation from 25. We're going to re-estimate 25 and say farmers made about $30 billion less than we thought they did in 25. And so from what I anticipated the 25 number looked like, there was a pretty big drop in the 26 number. So just in sort of round numbers, I like this number from the USDA. It's called net cash farm income. It's very simple. It's easy. It's revenue minus expenses, no accruals, no nothing. It's all just what happened in the calendar year. The expectation for 26, the USDA's first number is 158 billion in net cash farm income, an increase of 5 billion, give or take, from 25. So pretty small increase from 25. But last year they were anticipating almost 185 billion in net farm income. So they dropped $30 billion, a huge drop in that net cash farm income from 25. And that's what makes 26 look a little bit better than 25.
I was going to say, so it's not that there's an increase in 2026, it's that the bar got set so low by 25 that any increase is going to be good.
That's exactly right.
Okay.
Zoom out, that's still a big number. If you zoom out for 30-year history instead of just a 2-year history, right? 150 is a healthy-ish number for the ag economy. It's kind of on the trend line of, okay, every year they make a little bit more, a little bit more, a little bit more. But it's still pretty damaging when you look at how much it's going to cost to put the crop in the ground in 26. And a big driver, so the other kind of like aha moment when you look at these numbers is how much of that 158 is government payments, right? So this year, 26, USDA is expecting 44 billion of that 158 to come from the US government in the form of support program payments. So roughly, in round numbers, 30% of all the cash the farmers are going to make in profits come from Uncle Sam. And that, my friend, is a very big number.
So at what point does that become a situation where it can correct? I mean, because the obvious phrasing that's going to get used with that is like socialized agriculture. Is that?
Are we there yet?
Yeah. I mean, are we there? Is there a mode of correcting that? Are we there yet? I mean, what's the?
Yeah, look, I would not go nearly that far, right? To say like, oh, this is sort of government-funded agricultural production. That's absolutely not true. This is not uncommon to see in periods of stress when there's dislocations in ag markets, that the government comes in as a stabilizing force. It's one of the things that makes our food system so stable, secure, persistent across time and cycles. So it's a natural function of the U.S. government saying an important thing for us for national security is to make sure that we have access to food and it's safe and secure, and we can persist that supply of food in good times and bad. So this is normal-ish to see this type of support, and normal for most agricultural production economies. So if you go to Brazil, or if you go to parts of Europe, or if you go into China, right? China has a very heavily subsidized agricultural sector. India, massively subsidized agricultural sector because it's important to their national security interests. So it's not as if we're just propping up agriculture for no reason or for political reasons. This is important stuff to make sure that farmers get through tough times, to continue farming through good times, right? And you see the fluctuation happen. When revenues go up, that percentage of government support programs go down. There is this give and take across those cycles. And it's sort of a natural offsetting thing to stabilize that farm income picture through years. Doesn't make it any less uncomfortable, I think, to a lot of producers who say, man, a lot of my money is coming from the government when I would prefer it to come from marketplaces.
Yeah, and well, I mean, from a world trade standpoint, that is trying to establish competitive advantage in the marketplace globally, right? Because if you are a country that doesn't have any government subsidies going toward agriculture, and you're competing against one that does, you can lose that battle very quickly. They can undercut your price. They can move more product because they have a higher reserve capacity. There's all kinds of things that give you competitive advantage in there that you have to sort of play ball with. What does the trend line look like from, like, let's zoom out to 5-year, maybe even 10-year on what that subsidy amount is on a trend, and where are we now? Yeah.
So again, the ebb and flow. So you're going to have years where you're in the 20s and 30s percentage wise. You're going to have years where you're in the 5 to 10 percentage wise. I think the average, again, somebody out there could check my math. I'd have to get some spreadsheets rocking and rolling to get the exact number. Squishy math. I think average throughout the cycle is something like 15%.
Okay.
Right? And that may be different in different countries. I think India is going to be much higher than that on average, and they're going to have probably higher average years throughout, right? Their level is just going to be much higher than our level, but we're roughly double that in 26 if the USDA's numbers become, let's fast forward the clock a year and we're re-estimating 26. If it's right, it's about 30%, so double the sort of average year, but not that much higher than, say, the 2015, 16, 17 era, or 2020. We were coming off of a few bad years. There was the COVID stimulus that kind of popped in. That was actually the peak of government support program payments. So you had MFP hitting, you had COVID era supports kind of all coming together at the same time. So 2020 was the peak of government support program payments. It just so happens we followed that up with a huge run in the ag economy because commodity prices went wild. So that's the difference. It was high in 2020. We're not that far away from a very high number. It just feels a little different because now the commodity prices are much lower.
So I'm guessing part of this 30% that you're looking at takes in the $15 billion that was pulled out for relief this last year, particularly towards corn and soybeans. And that was a relief package that came out. So, I mean, really, if you take what you talked about as kind of the zoomed out average of 15%, that relief package is what we're looking at right there. And then I think that we can probably anticipate that happening in 2026 based off of the projections that you're talking about with USDA, increase of $5 billion to overall revenue. And then sort of, if I go from the word on the street perspective, that a lot of that stimulus, I feel like it's a bad word in economics right now. Relief. Let's say relief.
Yeah.
It's a different way of saying the same thing.
Yeah.
So that relief package that came out really targeted that, like soybean, corn, and what we're looking at is the most tariff impacted commodities that we have. But a lot of the other ag out there is impacted by similar things, which is the cost of inputs. Our 2026, taking all that in, it sort of seems like we should expect that number of 30 billion to increase throughout 2026. That's the question. What do you think?
Yeah, I think so the number that the USDA is putting out is 44 total, which would be inclusive of things like ARC PLC payments, which kick in with lower commodity price. So there's an element that's going to be sort of naturally evolving with existing programs. And then there's the supplemental relief, right? So the bridge assistance payments, anything else that comes out. So those kind of things kind of stack onto it. And you're exactly right. It's targeted towards grains and oilseeds. Those are right now where the cost of production is higher, right? We haven't seen a lot of relief come out of that cost of production. And the price revenue you're kind of seeing it from both sides. Like revenue's down and prices are stable to higher on the input side. So you end up with that squeeze. But let's not forget the other side of the agricultural coin, which would be the livestock protein sector, which is actually doing quite well with lower grains and oilseed prices because feed prices are down and consumer demand is through the roof. So that is where I think the USDA is trying to balance out. Hey, we've got to put assistance where it's really needed, and the grains and oilseeds are probably the right place to put that assistance right now when you consider all the puts and takes of protein sectors versus grains and oilseeds. You got the specialty crop guys kind of sitting over here going, "Hey, what about us?" Yeah. And it's much harder to deploy capital or deploy relief payments to a lot of specialty crop producers because they're not as developed market-wise. They don't have, commodity trading floors for cherries or, heads of lettuce. It's just a little bit of a different, like produce is different. Nuts are different. So they're a little bit harder, but I'd say consumer prices have actually probably helped out a little bit. So consumer demand is kind of helping the specialty crops. Cost of production ain't going down, but they're able to at least chew through maybe the higher cost of production because consumers are very hungry for fruits, nuts, vegetables, things that aren't traded on the Chicago Board of Trade.
So throughout 2026, it seems like what the USDA is counting on, and I think what most people are counting on, is the high input prices are probably likely to be sustained throughout 2026. It doesn't look like those are headed anywhere. There's been no sort of discussion of tariff relief in 2026, so it looks like those things can remain constant. Do you see any unforeseen things that could further impact this? And off the top of my head, since I live out west, there's no water out here right now. There's no snowpack. There could be a serious drought year moving in and loss of crop on that level. Do you think that could further impact kind of where we're sitting?
Absolutely. I mean, those kind of black swans, they're not even black swans anymore. They're more like just like kind of gray swans because you're almost you're seeing them so much more frequently than you used to.
It's like sitting in an old raft. If you ever been on the river in an old raft and you plug one hole and you think you're good, and then all of a sudden a new one pops. Yeah, it's kind of like that.
Exactly. You just got to bring the glue and put the patch in place there and hope you can get a bucket going. We'll just take that analogy all the way.
Yeah.
So there are certainly going to be things that right now, maybe look like a 50% probability, but will be 100% probability or a 0% probability when you get to the next USDA data dump, which is sometime in late August, early September. I haven't looked at their calendar yet, but it's sometime, about 3/4 of the way through the year. And then throughout that time, you're going to have Congress hearing from the trade associations, from farmers directly, like, hey, this is causing some stress. This is causing some stress. You never hear really the good stuff. Like, hey, I'm fine. I can imagine the phone boards don't light up with people saying like, you know what, I don't need anything. I'm good. Right. Like they're lighting up because people are looking at their P&Ls. They're looking at their land. They're looking at what 27 might look like or 28 might look like and saying, hey, I need to make some changes here. I need either some cash to help me like get past a barrier, or there needs to be a change in regulation or something to help adjust the cost of production or help me get to market faster. So that's where I think, there's going to be a lot of calls on Congress, calls on the White House in the next year for sure. Water is going to be one out west, which never not a hot topic of conversation. Trade is going to be one for sure. A lot of discussion about, hey, do we open China up for more soybean sales? But I'm more interested in fertilizer and bringing in fertilizer from China, Russia, Canada, right? Or maybe even bring some production back to the United States.
We talk about like starting to produce that in territory, because you can't do what we're doing is not sustainable.
Yeah, we used to make quite a bit of fertilizer here, and then it became more advantageous for us to import it, which I get, right? I'm a globalist from a economic, I'm a Ricardian trade fan, a free trade fan, economist. So I get the benefits of importing cheaper final products, but the cost is when you disrupt relationships across borders, you might not have access to that at the same level. And so farmers are kind of struggling with that. And that's going to be a big topic of conversation come March, April, May. I was talking to a farmer at a table at a conference just a couple days ago, and he's just telling me he's just like letting it ride, just watching the fertilizer prices and saying like maybe next week, like I don't know. And he's got to make some planting decisions in the next 3 weeks. And he still hasn't locked in some of the input prices because they're sitting a little higher than everybody likes. So that's causing a lot of distress, a lot of uncertainty, a lot of volatility, a lot of risk to pile up into the production function of U.S. agriculture. So I still think trade is going to be a big topic. Maybe we're all tired of talking about trade and tariffs, but sorry, we can't help it. It's going to be a big X factor in 26. I also think biofuels could be another topic for conversation later in the year. We'll see what 45Z cooks up. Are there more processors for sustainable aviation fuel? Can we make ethanol become more of a soak up of some of that excess corn supply? E15 year round is a topic of conversation. I'm not a big believer that's going to move the needle immediately, but if oil prices can get back up to something like $60, $70, $80 a barrel, well, then ethanol at E15 kind of makes some economic sense. So there's some X factors for sure, Mac, that I think are going to change this outlook. There's on average, the USDA changes this outlook, the February net cash farm income, by 15% by the end of the year. So that's the average. Some years it's much higher, some years it's much lower, and we'll see where they go from here as the year unfolds.
So how do you think that this affects just basic land values, right? And this is such a loaded question because land value one county over can be affected. You can't generalize land value in the U.S., but I'm going to throw it out there anyways as a generality, and we could break it up even into sectors. You could go west, midwest, east, or you could go and you can cut in the south even, and there's another division. What we saw in 2025 was almost exactly point for point. Like I got to give you a pats on the back here when I can. Like we hit like right on.
Nailed it.
You nailed it last year. on everything across the board. It was like we were looking at a flat line, possible increases anywhere from 10 to 20% in some areas, but mostly flat line, some areas declining upwards of 20%. And that's going to be a county to county thing always. But that's what we're hearing is there's some areas that where you can't move the land because of the cost of inputs. Some areas where it's more recreational, you're seeing an increase in demand because people want that land. Some areas where it's commodity production, but feed for cattle is selling at a premium because of the premium price of cattle. That's sort of driving things. How do you see this playing out into 2026?
Well, I hate to just, echo us from a year ago, but it seems very similar in terms of the root economics that are affecting different sectors. I think the cattle cycle's continuing to run hot. So you've got that pull in the pasture ground, you got that pull in the recreational territory. So in cattle country, places adjacent to major metropolitan areas, there's still a lot of cash. And so I think properties are going to see some appreciation anywhere there's pasture ground, anywhere you've got sort of cattle adjacent to, you're going to see some upward pressure. Southeast is where I think the greatest hot zone is. I'm not calling for necessarily a decrease in those areas, but if there's going to be a place that has the most downward pressure, it's in the Delta, where you've got this perfect storm of soybeans, cotton, and rice, all expensive to produce again this year, all with markets who are reliant on maybe China, the China consumer. And it's just difficult right now to move that. Probably got oversupply in the Delta. So that's going to cause maybe a cash crunch. That means buyers don't have as much cash to pay up. And people who want to sell have to take a price that maybe not be their top price, but they're willing to negotiate down a little bit because they've got to get some cash flow rock and roll. And so Southeast, it's kind of my maybe area of greatest caution. But I don't think we're seeing like huge fallouts here, right? These are marginal changes in overall average land values. I think Pacific Northwest down to the coast region, maybe some settling of so there's, where there's water issues, we'll see those play out this year, drought year maybe. So it kind of depends on how, if we get some late snow, could be different than if we don't get some late snow. That may change the outlook a little bit. But I don't anticipate the same level of land pressure that we got last year and the year before. The nut markets coming out, where that was a really tough run for land markets in the San Joaquin Valley and parts of California, even up to the Pacific Northwest. Hopefully that's behind us. We've seen some of the dislocations there solve themselves out. Now we're looking at wine, right? So I think this could be the year we see a little bit of wine production and land valuation adjustments in the wine business. But overall, take that all together, I think you're kind of in that same, like, maybe steady as she goes, maybe a little bit uptick adjusted for inflation. Not a, pop champagne kind of year for returns, but not, pop champagne the other way because of negative returns, right? So kind of somewhere in the middle.
Yeah, and some of the trouble spots we're keeping an eye on are that northern Colorado, Nebraska, the Dakotas, areas that tend to be arid and dry and aren't getting water relief and have high inputs are the ones that we're kind of looking at of trying to figure out what's shaken down in those areas. That's a little more impacted because as you move south from those areas, you do have more water, you do have more down, like there's more resources there, and that's one of the ones that, as from our perspective, is kind of like, okay, how's this going to play out? That's one of the ones. What's some other insights that you were able to pull out of the USDA report, or were there that sort of shed good light on the state of things?
Well, people tend to gravitate towards some of the negative thing. That's just the way we are as a dismal science. But I mean, there's definitely bright spots. You look at the health of the animal products and protein sector, a lot of positivity there. Poultry, hogs, cattle, all seeing good gains in profitability. The dairy sector struggling a little bit, but when you're able to sell your 5-day-old calves for, whatever, $1,500, you got a pretty sizable offset to maybe some declines in milk prices. So I think proteins, largely that bright spot. Most of the sector level ratios still look pretty healthy. So you look at overall debt to assets, right? That still remains fairly low. So we don't see a lot of over leverage like we did maybe in the 70s and 80s. Good levels of interest rate expense. So not seeing that continue to run. I think there was some concern like, well, everyone's just going to take on debt and it's going to get more and more expensive. And, interest expense is going to sort of really stress the overall system, which isn't happening, right? You're sort of seeing the level off of interest expense because we got some relief on the short-term rates. Long-term rates are kind of holding steady, but short-term rates have come down quite a bit. And the outlook is for more cuts in the short term. So all that, I think, leads to some positivity around the financial health of the sector overall. So yeah, maybe headline numbers down a little bit. You've got some stories behind that on grains and oilseeds, but the balance sheet looks pretty good. Income statements will need some healing, and in some sectors look good and some sectors don't. And overall, I think we're kind of in maybe a bit of a repeat a year for 26 as we had in 25. And there's still lots of good stories that happened in 20. There's some bad stories and some tough stories to talk about and hear, but there's still a lot of good stories to talk about too.
Do you see, and this is from the loan side of things, which is where you all live, we have a delayed jobs report from January coming out. Like the shutdown didn't have the release of that, but there's a few other private polling places have released their numbers of like 22,000 hires and stuff. Looks like the job market has been pretty abysmal starting into 2026. Negative news, right, to your point.
Yeah.
But on the positive side, do you think that spells some possible relief on interest rates?
Yeah, I think there's a lot of wiggle room for the Fed to cut rates. Part of it is you're going to have some political, jockeying that happens with the changeover. Likely the Fed chair will be replaced come May and June, and so the name being bandied about, Kevin Warsh, probably from his statements make it seem like he's supportive of easing in that front more because inflation has come back a little bit. Consumer price inflation, not necessarily production cost inflation for farmers, but consumer price inflation is down a little bit. And our peers around the world have cut rates to a level relative to inflation that makes it advantageous for us to do so as well. We can't be out of whack, right? Because that's going to cause weird things. If we're more hawkish than every other central bank relative to inflation rates, then that causes funky things with our currency, and that's not what anyone wants. So I think he will be a balancing force on there to say, hey, we're going to probably relieve, not because I'm politically owned by by what people in the White House, but I'm looking at the level of short-term rates, policy rates to our inflation rate, and we have room to reduce. I think that's the right call. Longer term, though, interesting dynamics there on the long-term rates, right? So quantitative easing, I don't think the balance of the Fed come second half of the year will be as favorable for things like buying bonds in the marketplace, right? And sort of supporting lower interest rates on the long term. So maybe we see a steepening of that curve later this year. Great for operating debt, production debt, shorter term debt, less opportunities maybe to refinance at better rates on the long end.
Gotcha. And I appreciate that because all of those conversations get very muddied by politics. So it's good to get the pure economics perspective because we both know.
Yeah, I just wade out of that. Like, people say I'm wading in it. I wade out. I go the other way when people are like, no, let's just talk about economics and what people think and like what makes sense, right? That's where I like to live.
Yes. So 2026. We're probably looking at, are we looking at a direct clone of 2025? Is that kind of?
As it sits today, I think that's what the data would tell you. Now, you and I both know history doesn't repeat itself, but sometimes it rhymes. I think it will rhyme. I think 26 will rhyme with 25, but there are going to be things that change. There are going to be things that we don't know today that are going to disrupt. There could be a drought in South America. There could be a disruption to trade. There could be a new deal that unlocks things, which means, rewind the clock to 2020. I think everyone was talking about at this time of year, probably maybe 2 months from now in 2020, how farmers were not going to survive. And they couldn't. We can't move grain. There's the prices were in the toilet. And about halfway through the year, it was like, oh, wait a minute. There's a global disruption in supply. There is actually quite a bit of production here in the United States. The dollar was weakening, trade was booming, and we ended up with one of our better years in 21 and 22. So you never know, right? When you look at the beginning part of a year, you might say one thing, predict one thing, but you've always got to think about that cone of uncertainty. What I'll say about 26 right now, I'm putting a wide cone on it. So it kind of looks like we're here maybe tilting down a little bit, but there's a lot of upside, a lot of opportunity there for things to change and make prices go up a little bit. There is some downside risk. You could see things get, slightly worse, but wide range of outcomes right now, just given how much each little element of the ag economy has in terms of uncertainty.
Excellent. Any prospective opportunity zones that you see in the marketplace now?
Well, I encourage always, this is, if you're a borrower, you're a landowner, this is your time to make that like interest rate plan. You talk about a marketing plan. I'm going to sell my grain at X or Y or Z price and kind of like hedge it all out. You got to do the same thing with your operating debt, your intermediate debt, and your long-term debt. Have a plan, watch interest rates, because it's going to be a year. It's never a straight line. There's going to be opportunities to lock in things, refinance things, purchase things, right? So keeping your eye out for good deals in your marketplaces. This is the time to sort of reformulate that plan. It's kind of a quiet period for a lot of producers. Like if you're in the grain sector, maybe this is your time to really do those strategic planning. And this is a year it's going to pay for itself. If you are ready to move, when things happen, you're going to beat your neighbor. You're going to beat your competitor. You're going to beat South America, right? That producer down in South America, because you've done the math ahead of time and you know what the numbers are and you're ready to strike. So this is if I could voice one thing at the first quarter of every year, it's plan over plan. And this is going to be a year that those plans pay for themselves in spades.
Excellent. And with Farmer Mac, when is the next report coming out from Farmer Mac, just to cue people in?
Right. So a couple of things happening. Farmer Mac, we got our annual earnings call coming up February 19th. So you can tune in for that. We release, our 10K and all the earnings around Farmer Mac with a lot of great information there on sector performance information in that. We also do regular webinars. So go to farmermac.com/events. You can see webinars. We've got one coming up with Dr. David Cole, always a perennial classic here at Farmer Mac. We release issues of the feed throughout the year, every quarter. And then we've got our farmland price index. We should release that within the next couple of weeks. So if you're interested on how
next couple of weeks on that one, I was definitely curious about that one.
Yeah. So we're trying to get our Q3 numbers out, but Q4 numbers will follow closely behind those. And again, that's tracking the traded land, not just what we're surveying, not what we're seeing in appraisals, but what's out there actually trading in the marketplace, which I know UMAC, that's gold data right there, to be able to actually see how are people selling and buying and what prices. That's gold.
Excellent. So 2 weeks out, I'll be tuned in to Farmer Mac and grabbing your PDFs.
Hey, you call me afterwards. We'll talk about it. All right. Happy to do that.
That sounds perfect. Well, cool, man. I want to appreciate your time. I know that we've jockeyed this meeting around all day, so I want to let you get out of here when you can and get your Friday moving. But I really, really appreciate this as always. Jackson Takach, thank you.
Hey, it's a pleasure, Mac. We'll talk to you again in a quarter.
Excellent. Thanks.
Thank you.
This concludes this episode of the National Land Realty Podcast with Jackson Takach of Farmer Mac. Jackson Takach, of course, is the chief economist and head of Farm and Ranch now, formerly head of strategy, research, and analytics. Cool upgrade for him. Anyhow, hope you learned something from this. Please remember, subscribe to this podcast, whatever platform you're listening to this on. There's a subscribe button. Click it, follow us, whatever you can, and introduce us to your family and friends. We have a lot of value in this podcast. We want to make sure everybody gets the word. Thank you.